Hey Peter, I appreciate you coming on, man. So yeah, what question can I answer for you?
So my question is to you is in the beginning of your real estate journey and when you raised your funds, I guess in the beginning I was just like love to hear how you were able to raise funds and the strategy took. The reason I'm asking that is I have never raised funds before for a real estate deal. So I just love to hear how you started it.
Right. So I'll kind of give you a quick overview of my investing journey, and then that will touch on the various times I've raised capital for different reasons. So when I was starting out, I was house hacking small multifamily. So I was using a VA loan, so I didn't need to raise any funds for that. FHA loan. I had an FHA loan, so it was another house hack, a small 4 unit. And then I started doing some off-market deal finding. When I got my first seller finance opportunity, that's when I needed to start actually raising some funds. And what I was able to do was, the first person you should always try to raise funds from, if possible, is the seller. So what does that mean? In this instance, the seller did have a lot of equity, and between a combination of the seller's equity and between what the bank was willing to offer me. Okay, he owned 20 rental cabins worth approximately $1 million. He had around $500,000 of equity, and he needed $200,000 of that. That got me thinking, if I take out a new loan and then I combine that with the seller financing a portion of it, I might have to come out of pocket with little to no money. But I needed to raise capital for 30 days to actually close on the property before the seller can finance me back based on his equity. Long way of saying I needed funds for 30 days, approximately $150,000 for 30 days. And that was the first capital raise I did. So what I did was actually tapped into my own resources as much as possible. So I pulled money out that I had in a HELOC. I sold some assets. I took out some loans, like some personal loans, credit card loans, whatever I could, because I knew it was temporary. Plus, I raised 40,000 of capital between two friends and the military who were familiar with what I was doing because I was talking about it, but they didn't really understand it. But I did tell them, hey, if you give me $20,000, I will give you your $20,000 back in 30 days plus $2,000 or 10%. So the first thing I did was reach out to, let's say, friends and family who were already aware of what I was doing. But at that point, I did house hack a few properties, but I've never done anything like that. And the idea was to explain it as simply as possible. I could have said, oh, I'll give you, if you lend me $20,000, I'll give you 2 points and 12% annualized over. And it's like, no, that was
Yeah.
like, oh, way complicated, right? So I said, I'll give you $2,000 plus your $20,000 in 30 days because that's all I needed it for at the time. So that was the first ever time I raised capital. And the idea was through friends who were familiar with my investing journey. And I just asked for it basically and explained to them very simply what the returns were going to be like. That is very different than the way I raise capital now. And even the way I started raising capital to scale my portfolio is very different than the way I raise capital now, which I can go into if you'd like to hear more about kind of the progression of capital raising.
Oh yeah, yeah. I'd love to hear that.
So then when I started raising capital to buy properties, leveraging creative finance out of state, I started with something called private money partnerships. So basically, instead of getting a private money loan or a lender where, let's say they give me $100,000 and I give them 12% interest and then pay them back in a year, I started with private money partnerships, which means the lender or the partner would bring the funds for us to buy the property, and then they would take a percentage of ownership of the property, which gives them the cash flow and then the other benefits of real estate investing, which includes, the appreciation, the debt pay down, the depreciation and tax benefits, plus a portion of cash flow. So that's how I started because that was the easier entry into raising capital was private money partnerships because I'm giving up ownership of the asset that I'm bringing. So basically, we do the deal, we find it, we negotiate it, lock it up, put it under contract. They provide the capital, and then I handle everything else after closing, and then we just split the returns. Now I still offer that as an option, but we're primarily just doing private money lenders where they get a fixed interest rate return. I don't have to give up any ownership. It's logistically much easier because it's less having to create a new LLC together and all these extra documentation and work involved. It's just they're secured by the property, right? But I don't have, they're not an owner of the asset. They're just a lender on the asset in either first or second position on the, in terms of debt on the property. So that was kind of the progression. What I've done is the more, and it's something that's really hard, um, to feel comfortable with. I know it's definitely hard for me. It's, the more you talk about what you're doing, the easier it is to raise capital, because people want to put their money to work. And if you're offering them great returns, they want to be part of that. They want to receive those great returns. The issue is if no one knows what you're doing, or they don't know your experience or the fact that you've been consistently doing it, then it's impossible for the money to find you if you're not looking for the money, right? So it
Okay.
starts with sharing, right? Sharing what you're doing all the time. Even if, do you want to go through your experience and maybe I can provide some very specific feedback? Or is that a good enough general overview of the way I've been able to raise?
So, oh yeah, you look, I'll give you what my experience in real estate, and maybe you can help me
Sure.
implement some of that stuff that you did. And sharing is something that I have never done before. It's just maybe a few people. So yeah, so how I started real estate is kind of similar to the way you did. Is I bought my first rental property just traditionally,
Mhm.
just a traditional loan, about 4 years ago, and I continued to buy and buy and buy, and I realized that it's not sustainable
Right.
because I just ran out of money. I was about to run out of money, so I couldn't do that, keep doing that. And how I purchased these properties, by the way, I bought it from the turnkey company, so I didn't really do any
Oh, okay.
renovation or anything. So it was a turnkey company, so I had everything lined up where property management all taken care of.
Mhm.
So that continuing to buy those, I wanted to buy some more. So that's how I started learning about wholesaling. And this wholesaler mentor slash friend, he taught about creative finance, and that's the way Pace teaches. So that's how I got in the rabbit hole of trying to find out what Pace was doing, because that's who popped up on the
Right.
when I did all this stuff. So I joined Sub Two, and that's where I am now, trying to buy more properties more creatively now. It's
Right.
just
And I
the
think,
interest fee is a lot lower.
right. And you have an advantage of already having a real estate portfolio. It's a lot easier, in my opinion, to raise capital with that experience. Um, the question I'll ask you, do you have deals that need funding? I mean, you should always be capital raising, even if you don't have deals right now, but do you have deals
Mm-hmm.
that need funding right now, or?
I do, but it's not a single family to what I'm trying to raise. Uh, and the reason why I don't bring that up too much, because it's a bigger amount, and also I don't have experience in multifamily. This is a hotel conversion, so it falls into the multifamily, and so yeah, I am trying to raise that. Have another 45 days to try to raise that, but haven't done a good job actually trying to raise funds for this group of people. So
But you have all the marketing material and all that. You just haven't put it.
yeah, so yeah, the pitch deck is almost done. Because we've just been going back and forth and trying to
Mhm.
finalize the pitch deck and the numbers. So that's the reason why I haven't been able to pitch. I have pitched some people that I knew, but I don't have the pitch deck ready yet.
Right.
So um but yeah, I'd love to hear like how, other than like talking to people directly, like did you like put it on
Well,
social media?
you're gonna have to talk to people directly since you're syndicating the funds, right? Or are you looking
Yeah.
for one or two lenders? Sounds like you're trying to syndicate the funds, so you're gonna have to talk
Uh,
to
I
people.
don't think I want to syndicate this fund because
Oh.
I think it's a bigger amount. So I think the people, if they're interested, I think they want to be a PMP
What's the
on
total
this deal.
capital raise?
Total raise, if they are all in, it'll be 1.9 million.
Mhm.
Uh, or it could be the 10% um, raise, which is about $260,000.
Yeah, one of those is a lot easier than the other to capital raise.
Yeah.
Yeah, the hard part is going to be if you want that full amount, it's going to be hard for one or two people to provide. It's not that they're not out there, but almost $2 million of capital, you're probably going to have to
Yeah.
syndicate for that, even though it's on the lower end of, for what people syndicate for. It's probably going to be too hard to find one or two individuals to fund that. The lower amount, definitely for the right private money partner, I could see that working. But I mean, I kind of leverage it all, but it really is personal. I've never raised money from someone who I haven't already connected with before, typically multiple times before. Those are my best lenders or those that I have a relationship with. That doesn't mean I haven't raised capital from people who maybe we've talked one time or on a Zoom call, but for the most part, people work with me because they like me and my business and what I'm doing more than because everyone's offering 12% or 10% or whatever. It's kind of the same. So it's like, how do I set myself apart? It's just who I am, the person that I am. And that's where showing consistently what you're doing is really valuable. It's really valuable because it's not only is this person talking about this one thing now with returns? What have they done over the last 1, 2, 3, 4, 5 years, right? Because people love people that are consistently putting in the work towards a specific goal. So that's what I've really focused on. But I will say, I mean, I'm very bad at social media. I've done a very poor job, I didn't even really start talking about real estate investing and showing the world until after I had 30 rentals because I didn't feel comfortable. I didn't feel comfortable doing
Mhm.
it. I didn't really need to leverage other people's capital at the time, between creative financing and house hacking. But like you said, it's not scalable to grow a portfolio without raising capital. And even now, we have a rule in Coast to Coast Vets that we don't use our own funds to buy properties. We only use other people's because of the fact that that's a scalability issue. But with all my capital, what I do is I lend it to other people so they can, grow their portfolios at the same, because if I don't have funds, I can't lend it. That's fine, but at least that doesn't inhibit or prohibit us from being able to buy properties because of our lack of funds. But what I've
Oh,
done more so, yeah, just telling people what I'm doing, showing people what I'm doing, whether it's in real estate mentorships, whether it's in communities like this one, whether it's on my personal social media, people that I meet at events or in person. You know, I'm not one to really raise capital from family, even friends necessarily, unless I met them through investing, just because mix, I don't want to mix like money and family just because, it's just an extra layer
that
of
makes sense. Yeah.
unnecessary,
Yeah.
there's so much money really out there from lenders that it's not even worth the risk in my opinion. Even if it's great or bad or whatever, I just don't want it to ever, that's a different conversation with a family member than it is, a lender. And no matter what we say, it's hard to, to separate the two. So yeah, I mean, it's kind of everything now. Social media, part of the reason why I've created this community to put together, buyers and investors, wholesalers, lenders, connectors. And maybe that's a great way to start if maybe it's networking being more efficient and leveraging the work that connectors and other capital raisers are doing. I know it's a little unique in your situation because it's not necessarily your deal. You're coming in, I assume, as a general partner, providing capital to the deal, or you're getting some equity ownership from that.
Yeah.
So you're supposed to raise the capital. But if you could find an affordable connector to raise that capital for you, that can be an option. And that, that's just leveraging someone else's capital raising skills. So I kind of do it all. I connect with capital raisers and connectors. I connect with lenders individually. I post on social media now. We have them in our CRM and we're trying to send messages out. We're not very advanced in that regards yet. I'm still manually texting and messaging people, even though we do
Hmm.
have CRM. We're growing in that area, but for the most part, it's been a lot of personal relationships with primarily with other investors and lenders through real estate investing communities and mentorships and just people that I've met in the past.
Oh, I see. Okay. Yeah, that's a good point. That's yeah. If I can, yeah, I'm open for that. Leveraging someone else that's raised funds for sure. Yes. I mean, honestly, if I could just get into this deal and not even make any a penny, I'm fine with it. Just to get the experience going and
Right.
have my name in there as a as general partner, and that's a win for me.
Yeah, I mean, I would still
Because
definitely for sure monetize it, but maybe it's the connector's fee is what you collect and then you pay out, because then you'll get the equity side, which will be nice. So, that could still work. You'd still get paid as a general partner
Mhm.
potentially and pay your connector fee instead of you having to pay them. So I think if you don't feel like your let's say audience or your network of capital partners is there right now, a connector route would be the most efficient path to do so. I don't know how many connectors we have in the community yet, but every day we're growing, so we'll definitely have more and more. You said you're part of sub two, so that's always a great place to post and see who's raising capital for other people's deals. We do that as well, but we have plenty of deals right now that we need funding on, so we don't really
Oh, okay.
connect as a first. That's more of like a second or third or fourth.
So capital is always needed in your business, no matter.
We only have two inputs in our business, right? It's capital and deals. So it's always one of them is the bottleneck. Either we have more deals than capital, more capitals than deals.
Mm-hmm.
So it just depends at any given moment, because everything else is operations, right? It's our transaction coordination, operations,
Yeah.
asset management, property management. That those aren't inherently bottlenecks. Those are just kind of part of our overall operations and maintenance. Our
I
inputs in our
see.
business are capital and deals. So it's always one of those. Um, there's more of one than the other always.
I see. Gotcha. So right now, are you the capital raiser for your business?
Yeah. So my business partner and I both underwrite deals. We have, our team. But
Mm-hmm.
I am primarily the capital raiser. Doesn't mean my partner doesn't raise capital. Doesn't mean our asset manager or our ops team doesn't raise capital as well. But I'm the primary capital raiser. That's why we're streamlining
Okay.
it, because we've been able to we've been able to get a lot done through the system that we have. But I know that there is a more efficient and standardized and optimized process for raising capital, which is what we're working on right now.
Okay. I see. All
Because
right.
we've done a lot
So,
of relationships with people and give someone a call or send them a text, and it's like, yep, deals funded, deals funded, deals funded. But we really want to make it more systematic, I guess.
okay. All right. My last question to you: do you just do mainly single family, or do you also do multifamily as well?
Yeah, good question. So, single family, small multifamily. The thing is that we don't want to syndicate to raise capital. So, we do things that can be funded by one, two, maybe at most three people. Right now, we've done a commercial dry cleaner, real estate plus the business. We've looked at a mixed use. There's 8 businesses on the first floor, 2 rentals units on the top floor. Right now, we have under contract, which we're gonna be closing on in a few weeks. Actually, it's the capital raise I'm gonna start right now. It's a 7-unit commercial mixed use property. 3 of the units are commercial businesses, and then the other 4 are rentals, which we're operating as short-term rentals. So it really depends, but as long as we can raise the capital to enter the property with 1 or 2 lenders, that's our goal right now. We don't want to deal with SEC laws, and
Oh yeah.
we don't want to deal with any of that extra work because our system works really well as is. We don't want to add extra wrinkles if we don't have to right now, because we've got a good scalable system right now.
Okay.
So it
Okay.
just depends on the entry costs, honestly. We've looked at over the last week, we've looked at a 10 unit, we've looked at portfolios, up to 20 properties in Washington, another 9 in Florida. So it just really depends. It primarily depends on those entry costs and if it's feasible to raise it through 1 or 2 people.
Nice.
Because a certain dollar
Are
amount just
you?
is high for most
Oh,
people.
oh yeah. Sorry. I was wondering if you are uh buying in California,
Yeah,
specifically LA County.
not LA County, San Diego County is my preferred, but yeah, we bought multiple millions of dollars last year just in San Diego alone.
Okay. Well, the reason I is someone brought this deal that's off market, but with an agent, it's kind of odd. It's not listed on the
Hmm.
market, but it's with an agent. It's kind of off market. Interesting because the person is willing to do owner finance.
Right.
Uh, I don't know. I think it's way over my head. It's a portfolio of like 6 buildings from
Mhm.
5 units to 20 units, I believe, and is
Nice.
all throughout LA. I don't think it's something that I could do. But if you're interested, I could send you that information.
Yeah, sure. I mean, I'd love to check it out. At least it'd be a fun one to underwrite and practice on. Um, the problem with Los Angeles and seller financing, it just California or really anywhere where there's a high loan amount, it just
Yeah,
more than likely will not cash flow. And then if there's a high loan amount, millions and millions and millions of dollars, the seller is going to want a lot of it up front. They're going to want high interest. They have a lot of leverage and not a lot of motivation. So, if they can, because their rent, if they own or finance it, the rent that they're making on it is probably significant, very high. So to replace that, you're going to need to pay them a lot monthly. Plus, yeah, they might want to tap into that equity, but then it goes against kind of what we're trying to do with a lower entry cost. We're gonna have to give them a ton of money. They're gonna want solid interest rate because they're really not as motivated in markets like like ours in SoCal. But that isn't,
yeah.
at the same time, we bought plenty of great deals last year just in SoCal alone. So it's always worth checking out and just trying to understand the seller's motivation above everything else, and then trying to structure a deal around that. But unfortunately, with these really large purchases where the owner owns it outright or, has a ton of equity, there's just not a lot of motivation. So it's hard to structure a great deal unless they're just done and want to just get out, you know?
I think they are done actually because they're
Yeah.
very motivated to sell. Yeah, I mean, I'll share that information. The person that shares her name is Lisa. But I could share that. But if you are gonna underwrite it, I'd love to just see how you underwriting that deal.
Yeah, maybe we'll have time tomorrow if we don't get a bunch of questions. We'll have time tomorrow to underwrite that deal since tomorrow's the underwriting session.
Okay, okay. So I'll shoot you that information. It's got some rent rolls in there, and they want $20 million, so it is a large purchase. So uh,
You know how much
yeah.
down?
So he's open. He's saying just shoot me what you're offering.
Yeah.
I want to say zero down, but I don't know if that's gonna offend them.
No, it won't. He'll want millions down. So sometimes another candidate for this is a seller carryback post closing or the Morby method, as we call it.
Okay.
Where you take out a new loan and then what a portion of that, let's say you take out a new loan for $20 million. Well, okay, here. If it's a $20 million purchase at 75% loan to value, that means there's going to be a new 15% or a $15 million loan, right? That's going to pay the seller back. And we have to come to the table with $5 million or 25% down payment.
Yeah.
Well, the seller is going to get the $15 million. And then after closing, they can send the funds right back to us and seller finance that piece to us. So
Uh,
that's the way to make it a low to no entry. And we've done that several times. But the issue is because you have the bank debt, typically at high interest in this market, and the seller finance debt, and we have the seller finance debt, we're going to need it to cash flow a lot of money to make it worthwhile. And that's, the rent to price is really, really bad, in California. You're playing more than just the cash flow game down here. You're also getting appreciation and large debt pay down and all those benefits. But
yeah.
that doesn't help you if you can't afford to cover the expenses for your property. So that's what
Services
I
debt.
underwrite it. Let's see what's
Yeah,
viable.
yeah. I see. I mean, I was thinking maybe the possibility of doing like co-living on these apartments, but I don't know if that's even possible. But
It just depends. Yeah. It's tough to say.
yeah.
With no,
Okay. I mean, I'll shoot you that information, and then if we have time tomorrow to underwrite it, yeah, that would be great.
yeah, or we can at least start underwriting a bit of it. I mean, it's gonna take a minute to underwrite a property like that, an asset like that, but we will
Yeah.
definitely, we could definitely look into it tomorrow for sure. That'd be fun.
Okay. So do you want me to send that information via email,
Yeah,
or
just email me. If you don't, here, I'll
I don't
try.
know if I have your email address, but
You can email this email right here.
good.
Or you just message me, DM me, and I'll send it to you again, since if your hands are full.
Yeah, I'll take a screenshot. So
Do you have any more questions?
no, I don't want to take more of your time. That's awesome. Yeah, I'll shoot that email to you, and then yeah, if we have time tomorrow to underwrite it, that'll be awesome.
Perfect. Cool, Peter. Appreciate you stopping by.
Yeah, appreciate you, man. Thank you.
I think I'm gonna call it quits for the day and just get back to work.
Okay. All right. Cool. All right. Thanks, Michael. I'll
Bye,
talk to
Peter.
you
Have a
soon.
great rest of your day, buddy.
Thank you. Okay. Bye.